Hello students, this is my lecture number 4 on security analysis, and probably I'm going to wind up security analysis in this lecture. We'll be taking up about 3 or 4 questions. As such, security analysis has got a limited scope for CMA final, but I'm doing this in extensive because we require this particular topic probably for other topics like portfolio management and other questions. So calculations of valuation of shares and how to value a bond. This will be very useful for us in the upcoming topics also. We'll be able to understand the topics better. And now the topic that I'm going to do is an additional part of valuation of bonds. As such, it is not very important, but I feel that you should have a little bit knowledge of this particular topic, and that is called as duration of bonds. In lecture number 4, we are going to discuss about duration of bonds. Okay, I suppose you have gone through my first 3 lectures, lecture 1, lecture 2 and lecture 3 on security analysis. This will be probably the last lecture on security analysis. After I complete this topic, my next topic will be portfolio management. So again, portfolio management is carrying about security analysis and portfolio management both together constitute about 25% of your paper as such, as per what they have given in the syllabus of your study material issued by Institute of Cost and Management Accountants, that is your ICWA Institute, has issued this particular module, the study material, where they have given that 25% of the paper will be based on security analysis and portfolio management. So keeping in mind the importance of this particular topic of portfolio management, we'll be doing it followed by after your security analysis topic gets over in this session, this lecture. Okay, shall we start? So let me start with the concept of what is called as duration. Concept of duration. Let us say that I've issued a bond of face value 1000 rupees carrying interest at 10%, and it is for 10 years. Now, normally what will happen is, if I draw the timeline here, beginning of the year is 0, then end of the first year, end of second year, end of third year, end of fourth year, end of fifth year, till end of 10th year. Each year, I will be receiving interest at the rate of 10% on 1000 rupees, that is 100 rupees every year. Okay, 100 rupees every year. Now, what I'm going to do is that I'm going to invest this 100 rupees that I'm going to get. This first 100 rupees that I'm going to get, I will be reinvesting this. Okay, reinvesting maybe at 10%, maybe at 9%, whatever is the rate of interest prevailing at the end of first year. Assuming that I'm reinvesting this at 10%. So on this 100 rupees, I will be getting 10 rupees here, 10 rupees here, not 10 rupees here, but 10 rupees here, 10 rupees here, 10 rupees here, 10 rupees here, and so on. Okay. Now this 100 rupees also will be reinvested by me, and I will start getting interest from third year onwards, 10 rupees each year. So like this when I do, and each of the years when I get this 10 rupees, that will again be reinvested. This again will be reinvested. This again will be reinvested. This will be reinvested. So that means what I am going to get at the end of 10th year, what I'm going to get at the end of 10th year, I may be able to recover that amount. That amount can be recovered by me before the 10th year also. Why? Because I'm doing reinvestment of each of the cash flows that I'm receiving. So before the 10th year comes to an end, maybe somewhere around 8th year or so, I may be able to recover not only the principal amount, but all the interest amounts also, that is 100 rupees every year for the next 10 years. So that will be 1000 rupees. Okay. Plus, I will be able to recover some additional amount, which means that I'm able to recover the amount that I'm going to get, the maturity value that I'm going to get at the end of 10th year, I will be able to recover that somewhere in the 8th year itself. So if I'm able to do that, then that means I'm able to recover my money before the maturity date. This 10 years is what? This 10 years is my maturity period. Okay, this 10 years is my maturity period. But since I'm able to recover this amount within the period of 8 years, this 8 years becomes my duration. So I will say that a bond having a maturity value of rupees or of 10 years, the amount of the maturity proceeds can be recovered within the period of 8 years. Bond which is having a maturity period of 10 years, we can recover that maturity value within a period of 8 years. So 8 years becomes the duration. So how it is possible? I've told you, every time I receive the interest, that interest will be reinvested. When it is reinvested, again I get some cash flow that will again be reinvested. Like this, when I go on reinvesting every cash flow that I'm going to receive, I will be recovering the amount before the maturity period. And whatever I recover within the period from 8 to 10 years, that is my additional benefit. But my maturity value I'm able to recover within a period of 8 years. So I say that 8 years is my duration period. So I say that every bond having the interest rate will be having every bond having the interest rate will be having the duration as less than the period of the bond. Every bond which is carrying a rate of interest, a coupon rate, will be having its duration less than the maturity. Now comes the question, if there is a zero coupon bond. If it is a zero coupon bond, that means I'm not going to receive all these cash flows every year. So if I'm not going to receive the cash flows every year, I will be receiving the maturity value only at the end of 10th year. So for a zero coupon bond or also for a deep discount bond, we have seen the meaning of all these things. Okay, a zero coupon bond or a deep discount bond which does not carry any rate of interest, which does not carry any rate of interest will have the as equal to duration as equal to maturity period, because I am not receiving any cash flows. Okay, now some points that will come on the basis of this. What can I say? I can say that in the case where my rate of interest is higher, my coupon rate is higher, or my YTM is higher, if my YTM is higher, then I will be able to recover more cash inflows and the rate of reinvestment will be higher, because in YTM I also have the rate of reinvestment. So if the rate of reinvestment is higher or the coupon rate is higher, then my duration becomes shorter. So two bonds having a 10-year period each, but one bond is having a higher rate of interest than the other. The bond having the higher rate of interest will be having a lower duration period. What am I saying? A bond having a higher rate of interest, as the rate of interest increases, the duration period will go on decreasing. Why? Because we are able to receive more cash flow by way of interest. Same way, even if the interest rate is not high, but if the YTM is higher, that is the IRR is higher, then my rate of reinvestment is higher, my cash inflows are going to be increasing every year, and as a result of that, since my cash inflows are going to be increasing, then in that case, I will be having a shorter duration. So higher the rate of interest or higher the YTM, shorter will be the duration. So YTM and duration are inversely related. As the YTM increases, duration decreases. Okay, a zero coupon bond or a deep discount bond will have duration as equal to maturity period. So this is the concept of duration. What is the definition? Definition is that duration may be defined as the weighted average life of a bond, which eliminates the risk of change in interest rates. Weighted average life of the bond. So the duration is, that is a period of 8 years. The period of 8 years is going to be the weighted average life of the bond, which eliminates the risk of changes in interest rates. That means even if the interest rate changes, then what will happen is I'm not going to lose anything. Only the duration will be going to increase or decrease. Now, since this particular duration concept was discovered by one Mr. F. Macaulay, we also call it as the Macaulay's duration. Macaulay. Macaulay's duration. Okay, so that is the concept of duration. So let us see the definition now. As I said, duration may be defined as the weighted average life of a bond, which eliminates the risk of changes in the interest rates. Since it was first introduced by F. Macaulay, it is also called as the Macaulay's duration. There is a shortcut formula that is derived for this calculation, that is given as D is equal to, D means duration, is equal to RC upon RD into annuity factor at RD rate of interest for n years into 1 plus RD plus 1 minus RC upon RD multiplied by n, where RC is equal to current yield. We have done the concept of current yield in the last lecture. Current yield, RC is equal to current yield. RD is equal to YTM. YTM concept also we have done in the last lecture. N is the term of maturity. That means the number of years. We will follow another formula that is called as a normal tabular formula, and that is given by duration is equal to summation of weights into present value upon summation of present value. So this formula will be using to calculate the duration from our side. So you can just make a note of this. Shortcut formula as well as the duration formula. This is the formula that we are going to follow. This is the shortcut formula. Either of the two can be done. But when we are solving the problems, I will be solving the problem as per the tabular formula. Then we have what is called as volatility of the bond. Okay. Volatility of the bond is sensitivity of the bond price to changes in interest rates. Interest rates, YTM. Changes in interest rate. The interest rate increases or decreases in the economy. I am not talking about the bond interest rate. When the economy rate of interest changes, when RBI declares a higher rate of interest or RBI declares a lower rate of interest, increases the rate of interest by a few basis points here and there, then in that case, the sensitivity of the bond price, how does it change? So that is calculated and that is called as bond volatility. And bond volatility is calculated with the help of duration. That is modified duration, not duration actually. It is modified duration. What is this MD? It is what is called as modified duration. You had modified IRR in capital budgeting, in investment decision, in your inter CMA. So like that we are having modified duration, where modified duration is equal to duration divided by 1 plus YTM divided by F. Now this F is going to divide only this YTM. F is what? F is the frequency of compounding. Frequency of compounding. So if it is annual figure, then it is 1. If it is semi-annual figure, it is 2. If it is quarterly figure, it is 4. So like that, F is the frequency with which we are compounding. Clear? So what we have to learn is this formula. Last time, if you remember, we had done calculation of change in price. How did we calculate? New price minus old price. That is one method of calculating the change. If they say calculate the change with the help of modified duration, then you have to make use of this formula. Minus modified duration into percentage change in YTM. And how to calculate the modified duration? Duration divided by 1 plus YTM upon F. Your annual YTM divided by frequency. Is it clear? Shall we take a question based on this now? I want to do question number 10 with you based on duration. Question number 10. Let us see question 10. Okay. Open your books to question 10, page number 82. Are you having it? Okay. A bond is issued at rupees 500, matures in 6 years. This is the face value of the bond. At the same time, it is also the issue price. The bond is issued at par. Maturity period is 6 years. Coupon rate is 12%. So 12% of 500 will give you 12% of 500 is 60 rupees. So every year you are going to get interest of 60 rupees. Market price is 470. That is the intrinsic value of the bond is 470. YTM on the bond is given to you 13.53%. This is also your discounting factor. If the YTM increases by 1.5%, change in YTM, calculate the percentage change in price of the bond. And if they had stopped over here, I would have used the old method, new price minus old price upon old price. But they have said employee modified duration. So since they have said employee modified duration, I have to make use of the duration formula. Okay. So now let us see how to make use of duration formula and solve the problem. This was the question. We are solving the answer now. Now, we require modified duration. Now, when we require a modified duration, first we have to calculate duration, because without duration, I cannot calculate modified duration. So let us see how to calculate modified duration with the help of duration first. Now, duration calculation also, you are doing it for the first time. So we'll have to see, we'll have to go slowly and see how the duration is calculated. Okay. So what we do is we prepare a table which will have about 5 columns: year column, cash flows column, discounting factor at the rate of 13.53%, which is your YTM. We calculate the present value and then weighted present value. So I have 5 columns: year column, cash flow column, discounting factor at 13.53, present value, weighted present value. Okay. Now year column, 6 years are there. Cash flows. What are the cash flows? Cash flows means amount of interest. What is the rate of interest? 12%. 12% calculated on what? 12% calculated always on the face value. What is the face value? 500 rupees. So 500 into 12%. So every year I am going to receive 60 rupees as cash flow. But that is up to year 5. In year 6, I will be having the redemption. So 60 rupees plus the redemption value. Redemption value, if nothing is given, it is face value. Okay, it is face value. So in the 6th year, since the redemption is going to take place, I will receive 60 rupees plus the face value 500. So I will be receiving 560 rupees. So you can see that every year it is the interest. Every year it is the interest. Last year it is interest 60 rupees plus 500 the principal amount. So that is coming to 560. You can show it separately also. You can show it together also. No harm. Discounting factor at 13.53%. How to calculate? I told you 1 divided by 1.1353 on the calculator. 1 divided by 1 plus k. K is 0.1353. So 1 divided by 1 plus k. So 1 divided by 1.1353, you will be getting first value 0.8808. Press the equal to function again, you will get 0.7759, 0.6834, 0.6019, 0.5302, and 0.4670. Now you multiply cash flows into discounting factor. Multiply. First figure, I will take up to 2 decimals now. Present value to be taken up to 2 decimals. Discounting factor to be taken up to 4 decimals if nothing is done. So multiply, you will get 52.85, 46.55, 41, 36.11, 31.81, and 261.52. Take the total of all these present values. Total of all the present values. 469.84. Roughly you will be getting 469.84. Roughly it is nothing but 470. That is your market value. So if suppose in the examination you don't have the time, you can directly write here 470. This is approximately equal to 470, which is nothing but your market price. Okay. Now what you do is for weighted present value. What is the weight over here? The weight will be the year. So year into present value. 1 into 52.85 is 52.85. 2 into 46.55 is 93.10. 3 into 41 is 123. 4 into 36, 144.44. Okay. Then you have 5 into 31.81 and 6 into 261.52. Now take the total of all these values. Total of all these values. That comes to 2141.56. 2141.56. So duration is equal to summation of weighted present value divided by summation of present value. Summation of weighted present value divided by summation of present value. So that is 2141.56 divided by 469.84. That will come to approximately 4.56 years. 4.56 years. Up till here it is clear? Okay. Now to calculate modified duration. It is an annual figure. So frequency will be 1. So I say modified duration is equal to duration divided by 1 plus YTM upon F. What is duration? 4.56. What is YTM? 13.53. In decimal, it will be 0.1353 divided by F, that is 1. Okay. When you solve this, you will be getting 4.02 years. We can see that the duration is less than the the maturity period of the bond, and the modified duration is further less. It is 4.02. In fact, modified duration reflects the volatility. Fine. Now, percentage change in the price of the bond is equal to minus modified duration into percentage change in YTM. We are using the formula now. What is the modified duration? Minus 4.02. Change in YTM is 1.5%. So when you multiply, you will be getting 0.0603 with a negative sign. Negative sign indicates decrease. So it is minus 6.03%. Minus 6.03%. So what can we say? We can say that price of the bond, the sensitivity of the bond, the price of the bond changes. Changes means what? Decreases, because there is a minus sign here. Since there is a minus sign here, this minus sign indicates that it is a case of decrease. Therefore, price of the bond decreases by 6.03%. Okay. Clear? So this is how we calculate bond duration and modified duration. You don't have to stress much upon this. I will tell you what is important here. Important is the valuation of bond. Let us come to question number 11 now. Question number 11. Quicksoft Systems has issued bonds with face value of 500 rupees. Face value 500 rupees. Coupon rate is 12%. Payable semi-annually. I told you always check whether it is annual or semi-annual. Market price is 475. Principal amount will be redeemed in 2 equal installments at the end of 3rd year and 4th year. Very important. Semi-annual if it is given. Then 3rd year means 6th half year. Double. 3 means 6. 3rd year means 6th half year. 4th year means 8th half year. Okay. Calculate duration and modified duration of the bond. Interest rate risk for a 1% increase in the interest rates. Okay, that means the price sensitivity. That means how much the bond value is going to change by if there is a change of YTM by 1%. Okay. Now, what is the difference between this problem and previous problem? There are 2 differences. In the previous problem, it was annual calculation. In the current problem, it is semi-annual calculation. Same way, in the previous problem, YTM was given 13.53%. In the current problem, YTM is not given. That means my first job is to calculate YTM. Okay, so let us start with the calculations. It may be noted that in the given problem, YTM is not given. Therefore, first we have to calculate YTM of the bond. So always your problem cannot proceed until and unless YTM is given. Previous problem YTM was given, so I directly started the calculation of the duration. Here the problem does not give us YTM, so first I will be starting with calculation of YTM. Okay, how do I calculate YTM? I say value of the bond is equal to interest into annuity factor plus face value into PVIF. What is the value of the bond? Current market value of the bond is 475. What is the interest? This value of the bond is 475. What is the interest? 60 rupees annually. Semi-annually, it will be 30 rupees. Semi-annually, it will be 30 rupees. Face value is now going to be split up. 500 is the face value, but it is going to be split up. How? 250 at the end of 6th half year and 250 at the end of 8th half year. Okay, 250 at the end of 8th half year. Now one more twist in the problem is that since you are redeeming half the face value at the end of the 6th half year, 7th half year when you calculate interest, it will not be 30, it will be 15 rupees because half your face value has been redeemed. So only the remaining half is there. So 15 rupees. When we calculate the rate of interest, it will be calculated on the 250 rupees. Okay. So in that case, 12% of 250 rupees for 6 months. For 6 months. That will come to 15 rupees. So 15 rupees will be the 7th installment that you are going to receive. And in the 8th installment, you will get 15 rupees plus 250. That is 250 plus 15, 265 rupees. So 475 is equal to 30 into PVIFA annuity factor at K rate of interest, that is your YTM, which you have to calculate for 6th half yearly instrument, plus 250 rupees, that is half of your face value, which you are going to redeem, into PVIF single cash flow at the end of 6th installment, 6th half year. 7th half year you will be receiving only half of that 30 rupees also, because 250 rupees has already been redeemed. So on the balance 250 your interest will be only 15 rupees in the 7th half year, and in the 8th half year you get 15 rupees plus 265. So it is actually 250 plus 15 rupees. That will give you 265. Okay. Now again comes interpolation. Then again comes your assumption. So trial and error. First I say if rate of YTM is 12% per annum, which means it is 6% for half yearly figure, then it is equal to the coupon rate. And if it is equal to the coupon rate, the face value and the market value is going to be the same, the intrinsic value. So I say that at K is equal to 6%, P0, that is the current market price, should be equal to face value, which is equal to 500 rupees. Now I want 475. My required value is 475. I am having 500 rupees here. So I have to reduce it. So I will take a higher rate of YTM. So from 6%, now 6% is semi-annual figure. Semi-annual figure. Okay. 6% is semi-annual figure. So I will take a higher value, that is 7%. So I say consider K is equal to 7%. Then in that case my right hand side will be equal to 30 into annuity factor at 7% for 6th installment, 250 into PVIF at 7% for 6th installment, 15 rupees into PVIF at 7% for 7 years, and 265, which I told to break up, is 250 plus 15. So that will give me these figures. 4.7665, always round up your factor values up to 4 decimals, plus 250, that is your half of the face value, into 0.6663 plus 15 into 0.6227 plus 265 into 0.5820. When I evaluate this, I will get these figures. Take the total, you will get 473.15. Again, both are not giving me the values, so I will go for interpolation. So by interpolation, I will get lower rate of interest 6% plus, I have told you how to do this, 6%, 7% required value. 6% figure that is given to me. I've got the 6% figure as 500, required value is 475, and the 7% figure I have just calculated, that is 473.15. So in the numerator what will come? Difference between first and second figure. Denominator what will come? Difference between first and third figure. Okay. So it is going to be 6 plus 500 minus 475 upon 500 minus 473.15. 6 plus 25 upon 26.85. So that will give me 6 plus 0.93. So my YTM is 6.93%. This YTM of mine is going to be again semi-annual. This YTM is again semi-annual. So how to convert into annual figure? Yesterday I told you last lecture. Yes, 1 plus k the whole raised to n minus 1, where n is the number of times you are compounding. So 1.0693, 1 plus k is this 0.693, whole square, y square because we are compounding twice, minus 1. That means annual YTM is 14.34%. Now, with the help of annual YTM 4.34% or semi-annual YTM 6.93%, I will be calculating the duration first, because they have asked me to calculate duration and the modified duration. So I say with YTM equal to 4.34% per annum, that is 6.93% semi-annual, we calculate the duration. For duration, I require again 5 columns, year column, cash flow column, discounting factor. Discounting factor I will take 6.93 because we are calculating the interest on a half yearly basis. So semi-annual discounting rate, present value and the weighted present value. 8 years cash flows. Now you can see that in the 6th half year, not 8 years actually, 8 half years, 4 years. 6th half year it is 250 plus 30. What is this 280? It is 250 plus 30. Okay. How did I get this figure? It is 250, that is half the amount of the face value plus 30 rupees. And here it is, here I have explained to you how you got 265. It is 250 plus 15 rupees. Discounting factor 1 divided by 1.0693. Up to 4 decimals you will go on calculating. Multiply the cash flows into discounting factor. You will get present values. Take the total of all the present values. You will get 475. Take the year column and multiply to present values. Round up the figures up to 2 decimals. Take the total of all the weighted present values and then find duration by the formula. 2783.24 divided by 475, that is 5.86 semi-annual. It is not a rate of interest, so you can directly multiply or divide now. We'll have to divide by 2. This is semi-annual. Semi-annual 5.86. That means I'm saying 8 semi-annual periods. So how many full periods? 4. The same way, 5.86 semi-annual periods. So semi-annual period, when you are converting from semi-annual to annual, here you have to divide by 2. To divide by 2. Okay. So it is going to be 2.93 years. Any difficulty in calculation? Just let me know through your messages in the comment box, or I have given you my number also. You can contact me on the number provided to you. This is my number. Okay. Now let us calculate modified duration. Modified duration formula: duration divided by 1 plus YTM upon F. Duration divided by 1 plus YTM upon F. Duration is 2.93. Annual figure, YTM annual figure 0.1434 divided by 2 now, because semi-annual, 2 times compounding in a year, that gives me 2.73. With the help of that, if there is a 1% change in YTM, what will be the change in the price of bond? Percentage change in price of bond minus MD into percentage change in YTM, substitute, that means minus 2.73. So if the interest rate increases by 1%, then the price of the bond decreases by 2.73%. Okay, up till here it is clear. As I have told you, if you are feeling that you are not able to write down, you can pause the video for a few seconds, write down, make the notes, and then after that continue again. It is as good as a live lecture. Only thing is that you are seeing the PPTs. You are not seeing my handwriting, and my handwriting is bad actually. It is good that I am not showing my handwriting. Only the limited places you will find my handwriting. Okay. Now let us come to question number 12. Question number 12. Ready? A 12% coupon bond, rate of interest 12%, with 7 years maturity is trading at market value 104 market price. Face value of the bond is 100 rupees. Coupon is payable annually. Bond will be redeemed in equal value at the end of 6th year and 7th year. Similar problem. You are required to find current yield, YTM, and duration of the bond. Exactly similar problem. Now, coupon current yield is what? Coupon rate of interest divided by current market price into 100. YTM we have to calculate by trial and error method. Duration of the bond, you know, 6 columns to be prepared, 5 columns to be prepared, 6 columns to be prepared, whatever it is, and then 5 columns, and then you take the summation of weighted present value upon summation of present values. Shall we start? Okay, current yield. First, the current yield formula. Current yield is equal to coupon interest upon market price. Coupon interest, what is the rate of interest? Rate of interest that you are having for the question is 12%. Face value is 100 rupees. Correct? So in that case, it will be 12% of 100 rupees. 12 rupees. Market price given to you 104. So 12 by 104. So that comes to 11.54%. 11.54%. Now, second is calculation of YTM. Calculation of YTM. So I say let the YTM be equal to K. I do not know what is the YTM. You can take K, you can take R. Common notation is K. Formula: market value or intrinsic value is equal to interest into annuity factor. So market value is 104. Interest, this is given. K rate of interest for 6th period. What 6 periods? 6 annual periods. 6 annual periods. Then in the 6th annual period, I'm also redeeming half the amount of face value. So 7th period, I will be getting half of 12 rupees, that is 6 rupees, plus half of the face value, that is 50 rupees. Sixth period, I am redeeming half of the face value now. Sixth period means sixth year. I am redeeming out of 100 rupees 50 rupees. So now the calculation of interest will be only on 50 rupees. That is 6 rupees. And the balance amount of principal 50 rupees. So 56 rupees. Okay. Now trial and error at k is equal to 12%. That is YTM is equal to coupon rate of interest. Market value is equal to face value. Market value is equal to face value. Correct, na? Now, I want 104. I want 104. Listen properly now. At 12% I'm getting 100. I want a higher figure. If I want a higher figure, I should take a lower discounting rate. So now from 12% I'll come down to a lower discounting rate. That is 11%. 11%. So when I take 11%, the value will be 12 into annuity factor at 11% plus 50 into case 11, PVIF at 11 for 6th year plus 56 into 11 for 7th year. When I do this, I will get the values like this. Market price comes to 104.48. 104.48. Is it the market value that I want? No. So again, there will be interpolation between 12% and 11%. Now remember that 11% is the lower value. So 11% figure will come first. Okay, 11% figure will come first and then 12% figure will come. So by interpolation, what is my 11% figure? 11%, always a lower limit first, required value 12%. Okay, 11%, required value 12%. 11% figure is 104.48. Required value is 104. 12% figure is 100. So difference between first and second, difference between first and third. So that comes to 11 plus 0.11, that is going to be 11.11%. Now this is my YTM. Once I get my YTM, I'll go for calculation of duration by preparing the table with 5 columns. Table with 5 columns. Year column, cash flows, discounting factor at 11.11, present value, weighted present value. 6th year, how did I get this 62 rupees? 50 rupees face value plus 12 rupees interest. How did I get this 56? It is 50 rupees face value plus 6 rupees interest. Discounting factors rounded up to 4 places, 4 decimals. Multiply the cash flows with the discounting factors. Round up the figures up to 2 decimals. Take total of all the present values. 103.96. You can see that it is coming very close to 104. If time is not there in the exam, you can directly write 104. Nobody is going to check. Okay. Then we have weighted present value 1 into present value. 1 into present value. 2 into present value. 3 into present value. 4 into present value. 5 into present value. 6 into present value. 7 into present value. Total of all the weighted present values 508.58. Clear? Up till here everything is final, full. What you can do is you can do the calculations. Once you know the method of solving the problem, you need not even look at the video. You just keep the video aside and you do your calculations fast with your calculator and then check the video for your answer. Once you know the method, you need not look at the video. You have to refer to the video only for checking the final answer. So I put this now in the formula for duration. 508.58 divided by 103.96. We get that as 4.89 years. 4.89 years. See that your answer, final answer matches with my final answer. Done. Now what I want to do is, see, I'm restricting myself to calculations over here and the nature of problems, because earlier they used to ask a lot of questions based on duration and all that, but now they have stopped asking major questions on duration. So we are going to concentrate now more on other things. Other things, that is what? That is, suppose, can we have, you have done in SFM, you are having what? You are having question or topic of capital budgeting, investment decision. Okay, risk analysis in capital budgeting. Now, what I want to do is I want to do a problem of bond valuation through capital budgeting process. Method of calculating bond valuation problem through capital budgeting topic. So now you understand, there were about one or two students who asked me, sir, why you are doing detailed problems on security analysis, because study material they have not given. I'll tell you the reason. The reason is that since we are having the topic of capital budgeting, portfolio management, you can have a combination of topics coming, which I'm going to show you now. That we will take up a question with this having a question on bond valuation, the concepts of bond, and it is actually a problem of capital budgeting, that is capital investment decision. So I will tell you how the two topics can be merged and how we can come out with a solution. So you never know at the professional level what can be asked and what cannot be asked. So you cannot say, that once you are a professional, that I do not know how to calculate this. Okay. Now, as a professional, you are doing direct tax also, indirect tax also. So you are having knowledge of both. Suppose after you become a cost accountant, somebody comes to you with some query on indirect tax. You cannot say that, Arey, this is not there in my syllabus. I'm a cost accountant, so I don't know anything about indirect tax. I don't know anything about GST. You have to have knowledge. As a professional, you need to have knowledge, right? So that is why I will be doing one such question. So let us see which question we are going to do. Now, what we are going to do? We are going to take up question on uh, question number 17. Question number 17. Okay. Are you ready with question 17? Page number 84. Page 84, question 17. Let us see what is the question. ABC Limited has rupees 300 million. 1 million is 10 lakhs. 3 million is 3 lakhs. 30 lakhs. 1 million is 10 lakhs. 3 million is 30 lakhs. Correct? 30 million is 3 crore. And 300 million is 30 crores. Now you need not write the full figures. You can solve the entire problem in millions only. There is no issue. Face value of the bond is total 300 million. 12% is the rate of interest. Outstanding with 6 years remaining to maturity. Since the interest rates are falling, the company is contemplating of refunding these bonds with a 300 million issue of 6-year bonds. Fresh issue, 6-year bonds, but carrying a coupon rate of 10%. What has happened is I have got a bond with 12% rate of interest. Economy rates of interest have fallen to 10%, but still I'm paying 12% interest on my bond. So what do I decide? I say that I will redeem these bonds. I will refund these bonds. Okay. And how to make the payment to them? When I make the payment to them, I'm going to have a fresh issue of new 300 million bonds for the same term period of 6 years. But now the rate of interest will be 10%. So I will be saving on 2% interest. I will be saving on 2% interest. Issue cost of the new bond will be 6 million. This is the issue cost. New bond 6 million. Call premium is 4%. What is the meaning of this? Call premium. Call premium is 4%. Call premium is 4% means that when I redeem, I'm redeeming at 4% premium. So if it is 104, if it is 100 rupees face value, I'm going to redeem at 104. So if it is 300 face value, I will be redeeming at 4% of 300. That is 12 million premium. Profit or loss? If I'm paying premium, it is profit or loss? It is a loss. From where do I meet that loss? Out of profit and loss account. Which means what? I'm going to debit this amount to profit and loss. Remember these points, I'm going to come back to this. 9 million being the unamortized amount of the old bonds can be written off no sooner the old bonds are called off. Marginal tax rate of the company, tax is given to you, rate of tax 30%. You are required to analyze the bond refunding decision. Meaning, should I refund the old bonds and replace it with the old new bonds or should I not? It is an investment decision. So I will be using the NPV method of solving the problem. Net present value method of solving the problem. If NPV is positive, I will accept the refunding decision. If NPV is negative, I will not accept the refunding decision. Okay. Now for NPV method, I will take my problem into three parts. First step, initial cash flow, if any. Second step, annual cash flows, if any. And third step, terminal cash flows, if any. Okay. Now let us talk about first step, initial cash flows. Initially, what is going to happen? I'm going to refund the old bonds. If I'm refunding the old bonds, there will be outflow of cash of 300 million. Followed. I'm refunding, I'm returning. Refunding means returning. I'm redeeming, I'm repaying the old bonds. So how much of cash outflow is there? 300 million. Okay. Now, after that is done, I'm going to make an issue of new bonds. New bonds issue is going to be on the same date of 300 million only. So inflow of cash 300 million. But when I redeem the old bonds of 300 million, I redeemed at 4% premium. So I have paid 12 million more. That is called as call premium. Call premium is also an outflow of cash. But since it is a loss and I debit this to profit and loss account, I will be getting a tax benefit or a tax shield. Since it's an expenditure, every expenditure leads to a tax benefit because your taxable profit reduces by that amount. I suppose you understand tax. Okay. So when you are saying that there is an expenditure, I say that very good. Why? Because I can show this expenditure and get tax benefit. So 12 million expenditure, on that there will be 30% tax benefit. So I reduce that amount. Okay. Now flotation cost of the new bond is given to me, that is 6 million. Flotation cost of new bond. It's an expenditure, outflow of cash at the initial stage. That will also come in initial cash flow. What about the 9 billion being the unamortized amount? What about this 9 million? That 9 million is already paid. There is no outflow of cash now. That was paid when the old bonds were issued. But it is unamortized amount. That means every year I had to debit a part of this to profit and loss account. Now, since the bonds are going to be redeemed totally, The full figure of 9 million I have to debit to profit and loss account. But is there an outflow of cash? No. But because I'm debiting this to profit and loss account, listen to what I'm saying. This unamortized amount I will be debiting to profit and loss account, but there is no outflow of cash. So I cannot show outflow of cash 9 million. But since I'm debiting this to profit and loss account as a loss, I get tax benefit of 30% on 9 million. 30% of tax benefit. So I will show only the tax benefit. I will not show cash outflow of 9 million. 9 million has already gone out of business when I issued the old bonds. So now what is relevant? Only the tax benefit. 30% of 9 million, that comes to 2.7 million. Okay. So now all this is a part of my initial cash flow. So that is what I have to show now. So let us start with the calculations. Question number 17. Write initial cash flows. Initial cash flows. Repayment of old bond. Repayment of old bond. 300 million. This 300 million is done at 4% premium. So it's a loss, call premium. So 300 into 4%. The call premium will be 12 million. Outflow of cash. That is what I'm showing. But there will be a tax benefit of this to the extent of 30%. So minus the 30% tax benefit, which I call as a tax shield. Tax shield or a tax benefit. Or you can write tax savings. Whichever word you are comfortable with. There is no hard and fast rule. 3.6. 12 minus 3.6, 8.4 million. Outer column. Then you have paid issue cost. Issue cost is called as flotation cost. Flotation cost of the new bond. Flotation cost of the new bond. 6 million. Then there is unamortized amount of the old bond on which there will be tax shield or tax benefit. Flotation cost of old bond amortized, which is calculated as 30% of 9 million. Flotation cost of old bond, benefit of 30% of 9 million, that is 2.7 million. 300 plus 8.4 plus 6 minus 2.7 will give me 311.7. This is all my net cash outflow. But now there is a fresh issue of the new bond of 300 million. So 300 million of cash inflow is there. So less cash inflows from the new bond, 300 million. That comes to 11.7 as my net outflow of cash. 11.7 net outflow of cash. Okay, understood all the calculations? Fine. Now let us see annual cash flows or subsequent cash flows. Yearly, what is going to happen? Yearly, what are the changes? Yearly changes that is going to take place. Let us try to understand first what we are going to do. Yearly figures, what we are going to have. First, I will be having savings in interest. Originally, I was paying 12% interest. Now I'm paying only 10% interest. So 2% benefit. Benefit means profit. 2% on 300 million. That means 6 million profit I'm going to have. So interest rate differential, which results in savings, will be 6 million. 10% minus 12% minus 10%. 2%. 2% of 300 million. Second, we had old bonds. Old bonds having 9 million as unamortized amount. 9 million as unamortized amount. Now that 9 millions would have got written off over a period of 6 years. That means I would be writing to the debit of profit and loss account 9 divided by 6, 1.5 million every year if the old bonds had continued. If the old bonds had continued, that 9 million would have been of the old bonds would have been written off over a period of 6 years. So I would have written off 1.5 million every year. Now, now my new flotation cost is 6 million. That 6 million is going to be divided by 6 years. That is 1 million every year. So again, I'm having a benefit of 0.5 million. Let us write down this first. First, write interest differential, savings of 6 million. How to calculate? 12 minus 10. This is the old rate of interest. Old rate of interest. This is the new rate of interest. So I'm saving 2%, 2% of 300, that is 6 million. Savings in amortization differential, 0.5 positive plus profit. Why? Because initially I would have, if the old bonds had continued, I would have divided 9 million by 6 million. So I would have got 1.5 million every year. Now I'm going to divide 6 million new bonds. 6 million divided by 6 years. So that will give me 1 million. So benefit of 0.5. Total benefit 6.5. Tax rate is 30%. 1.95. Net of tax 4.55. Now this savings in amortization differential. Is there actually an inflow of cash? I'm showing that as a profit. Is there actually an inflow of cash? No. So I say that this is a non-cash item. Non-cash item on which tax has been calculated to the extent of 1.95. So since I've included a non-cash item here, I will now exclude it once the tax is calculated. So less the savings and amortization 50. So whatever was shown over here, I'm subtracting that amount, saying that it is non-cash item. So I will get net figure as 4.05 lakhs. This is my inflow of cash. This is actually my present value of annual cash flows. Sorry, this is my annual cash flow, average annual cash flow. Now to calculate the present value of this, what do? I multiply by annuity factor. 4.05 million into annuity factor at 7%. What is 7%? Discounting rate. Sir, but discounting rate is not given in the question. Very, very important point. Discounting rate, if it is not given in question, what to do? Discounting rate, if it is not given in question, I will take a rate of interest. What is the rate of interest? 10%. Minus the rate of tax, 30%. So 10 minus 30% is equal to 7%. But why, sir? Because discounting factor is the cost of debt. Inter CMA financial management cost of debt. How did we calculate? Interest net of tax. Interest minus tax. So interest rate is 10% minus tax of 30%. So cost of debt is 7%. And cost of debt becomes my discounting factor. Cost of debt becomes my discounting factor. Please understand. That is why I said in the last lecture also that when you are doing any topic now, as a professional, you have to remember everything that is going to be done by you, right from foundation. Your BCom knowledge, your BBA knowledge, your BBM knowledge, your foundation knowledge, your intern knowledge, plus your final knowledge. Everything should come together. Because you're a professional now. You never know what application will come. Now this application comes. Rate of interest is given, cost of debt not given, discounting factor not given. So how to calculate net of tax? Rate of interest net of tax. So that comes to 4.7665. 1 divided by 1.07. Again I'm telling you same thing. 1 divided by 1.07 equal to function 6 times. Equal to function 6 times and then gross total function. That comes to 19.30 million. 19.30 million. What is this actually? This is my present value of cash inflow. Present value of cash inflow 19.30. What is present value of cash outflow? 11.7 initial cash flow. Yes or no? 11.7. So let us calculate NPV now. NPV is equal to present value of cash inflow minus present value of cash outflow. 19.3 minus 11.0. 7.6 million. Positive or negative? Positive or negative? It is positive. NPV is positive. What is the acceptance rule? Accept if NPV is positive. Reject if NPV is negative. I will accept. What I am going to accept? To replace my old bonds by new bonds. To refund my old bonds and replace them with the new bonds. So I'll write final answer. Since NPV is positive, company should replace the old bonds by new bonds. Since NPV is positive, company should replace old bonds by new bonds. Okay. Now please write a note at the end because you are going to forget 100% sure. You are going to forget from where 7% has come. So write a note at the end. Write a note at the end. Cost of debt, that is discounting factor, is not given. Therefore, it is taken as rate of interest minus rate of tax. Write this note, please. Okay. So, as I said, whatever questions I have done in security analysis, more than enough. Don't do any of the remaining questions. Theory, whatever is given, read the theory. Very important theory. More theory is going to come. Questions I have done because I require application of this in further topics. Remember that. Questions I have done because I require application of this in further topics. Knowledge of this is required in further topics. Therefore, I have done questions. But more of theory will come. You have Dow Jones theory, you have random walk theory, you have all those theories which are given in my book now. Please open the book and read the material. PDF format, I have given you the book. Open the book and read the material. Point is clear now. So with this now, I stop with security analysis. My next lecture will be on portfolio management. So you can start revising your security analysis problems. The next topic that we are going to start with is portfolio management. Till then, stay at home, stay safe, study hard. God bless you.